Now, let's talk more about tariffs and how they could have a very real-world impact. Joe LaVorgna advised President Trump during his first administration. He is now chief economist at SMBC Nikko Securities America. Not advising officially, I don't think, the president this time, Joe, but certainly you've got the ear of the administration. Will tariffs, if we get them April 2nd, will they destroy the stock market?
No. They're not going to destroy the stock market.
Why are we acting like they will?
Well, because I don't know. It's fear sells. Tariffs were in place in the first Trump administration. They had a very marginal impact in terms of actually didn't have any impact on inflation whatsoever. The Chinese bore most of the cost. They may have worked and had a more important impact had we not had the pandemic. This time around, tariffs will be used more aggressively. There certainly be some level of tariffs for revenues. Certainly they're used for a negotiation tool. But the other thing is they're also as a carrot to encourage capital to come back to the U.S. and for investment and supply chains to decouple from China to go to other places. So tariffs are a necessary and important tool, Brian, if you want to reindustrialize the economy, because in addition to the tariffs, this is a multi-pronged approach. You're going to have low and cheap and abundant energy costs. You're going to have a corporate tax rate for producers from 21 to 15%. You're going to have much more friendly business regulation. So the tariff is all part of that. Reciprocal tariffs are good. It's a negotiating standpoint. We'll see what happens on April 2nd. My best guess, Joe LaVorgna, is going to say there's still probably going to be some uncertainty. But so what? We've got tremendous uncertainty on taxes. If you look at the uncertainty index, you're going to see the uncertainty around taxes is incredibly high. It's one of the highest readings ever. And that relates back to the Tax Cuts and Jobs Act of 2017. Is it going to be passed?
Then why
that, to me, is
Joe,
what's driving
I think that was Steve Grasso's point. But why doesn't the president then, and I know you can't speak for him, but just say what you said? Say we're gonna put a little tariff on. We're hoping to bring jobs back. You're gonna pay a tiny bit more, but you're gonna make up that money in tax cuts and higher income.
Secretary Besson has said it. President Trump has said it. By the way, President Trump on the campaign trail consistently talked about tariffs. We're just surprised that he's actually implementing them. I say we, the collective narrative in the market. So, but the point is that you're not going to tell everybody everything you're going to do before you've done it. And the fact that investors are uncertain, well, can you imagine the people who we're negotiating with? Do you think they know what's happening? They're going to be off balance, and that's what you want. It's a negotiation. And my guess is it'll be very effective when all is said and done. But it's only 8 weeks. I mean, come on. I mean, it's like everybody wants everything yesterday. Give it some time.
And Joe, so
it's Tim.
And because it's only been 8 weeks, let's dive into the economy we have, not attaching this is so-and-so's economy, because frankly, this is everybody's economy at this point. We've had a number of numbers. We had regional manufacturing surveys this week that weren't great. We've had different dynamics with some lumpy, but also some, I would just say, some data series that are not necessarily telling you a whole lot in real terms. Where are we? Because we've suddenly gone, all I hear about is a recession now, when in fact a month and a half ago, no one was going near that word.
Yeah, part of it is this Atlanta Fed GDP now, which it's widely followed. They've done some good forecasts. This one, I think they're totally off on, because if you look at job growth, private job growth, you look at real income through January, it's up almost 3%. But the expenditure side of the data is softer. Some of the regional surveys you talked about are weak, but the national PMI, the manufacturing and services are pretty healthy. They're well above 50. And this week we had a huge gain in industrial production. So to me, the economy is healthy. I don't want the Fed to start easing rates in the short term. I think a lot of this inflation we have is partly due to the Fed being too easy for too long, and certainly those cuts last year. The first one I didn't mind. I advocated for that first cut because the data at the time looked very weak. But the Fed wound up going 100 basis points down. That was much too much. And the 10-year note went up 100 basis points. So the market clearly said that was a mistake. But the economy right now, to me, looks pretty good.